One of my mentors once told me something I never forgot, which is there are no such thing as good and bad markets. There are only bad prices.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into another episode of the Freedom Point. We're so glad you're here with us today. I have another amazing guest, ROCHA. Aaron, welcome to the show.
Thanks for having me, Jeremy. Excited to be here.
Yeah, I'm looking forward to chopping it up with you. You and I have a very similar background, so we'll dive into that a little bit here. But just to give my listening audience a little bit more information on Aaron before we get started, Aaron is the co-founder of Multivestors Group, where they specialize in connecting capital with opportunities. Aaron's role at Multivestors Group is to lead the charge from a real estate investing perspective and uses deep knowledge as both a broker and operator to help investors navigate the complex landscape of commercial real estate investing across all asset classes. Aaron, that last thing that I just said there, I'll read it again. You help investors navigate the complex landscape of commercial real estate investing across all asset classes. Are you saying that investors, when they read that shiny, glossy pitch deck, that there's actually more to the story than what meets the eye?
It depends, right? There's always more to the story, Jeremy. And I think what we mean when we say all asset classes is one of the things that I've learned is that markets are cyclical. And at certain points in the market cycle, it will make a lot of sense to invest in industrial or multifamily. And at other points in the market cycle, it will make less sense because those asset classes are overbought. So maybe you should rotate into, something else, mobile home parks, self storage. Maybe you can make up your dream for where the future is. I don't have a crystal ball, but I think one of the value propositions that we give to people is we like to always start with multifamily investing. And there's a lot of good reasons for that. Multifamily makes a lot of sense to people. You can kind of liken it to your home budget. If you pay rent, the rent has to cover the mortgage and the expenses, and then there's a return after that point below the line. So it's kind of easy to understand and to grok. And the other thing that's great about multifamily is it offers both short-term cash flow and long-term equity upside. So multifamily, I think, is a great starting point. But as Multivestors grows, I mean, we're only a 3-year-old company right now. But as we grow over 10, 20, 30 years, we definitely have a goal to expand into every asset class because, like you mentioned earlier, my background lends itself.
Yeah, that makes total sense to me. And I'm going to ask you more questions about timing the market later, since I know that you've got a crystal ball hiding around there somewhere. But with that said, can you tell us a little bit more about kind of that, journey from being a commercial real estate broker and operator to now you're an investor, and really what inspired you to make that transition?
Yeah, it was really my first job, Jeremy. So I studied economics in college. I graduated in 2012, and my first role ever was as an analyst at Colony Capital, which is a really large private equity REIT. And what we were doing, the year was 2012. You remember 2008, 2009, the agencies foreclosed on a bunch of American households because of chicanery on Wall Street with residential mortgage-backed securities. And the first thing that I realized, what are we doing, was we're buying portfolios of homes, 20, 30, 40, 50 homes at a time for pennies on the dollar. Homes in these tranches were previously, maybe 2-3 years earlier, valued around $400,000. We're buying them for $75,000. And just right away, like the light bulb goes off. We're buying these things below replacement cost. The reason we can do it is because we have the cash to buy right now and nobody else does. The agencies don't want all these homes on their balance sheets. So I kind of just get thrust into this world. Just, I'm 22, 23 years old. I don't know anything about anything at this point in my life. And the first thing that I realized is, oh, wow, like if you're able to buy low, it's really easy to sell high. I mean, that business is not a hard business to run. You can run it with a bunch of 22, 23-year-old analysts and a few leaders that know what they're doing at the top. So as my story goes on, and I'm not going to like belabor and walk through my whole background here, but I've been a commercial broker at JLL and Cushman Wakefield, two of the largest service providers. My first big job is I was the head of global real estate at Snapchat, and I helped them grow from 200 employees to more than 5,000 employees. And we did that all over the world, not just with offices, but with retail locations, with industrial for manufacturing type facilities. We even had a multi-family component to house our intern program in both New York and Los Angeles. And the more you meet these people in commercial real estate, the more you learn who they are. And a lot of them are family offices or folks that got rich somewhere else, and maybe they just own one asset or maybe they own 100 assets. But real estate is just a great way to grow and protect your wealth. And that message was something that it was important to me to spread to the masses. And when I started sharing with my friends, I realized that they were interested too. And that's kind of how Multivestors was born, with the mission to spread the word.
Yeah, I so appreciate that. And I would suspect that as your experience as a commercial real estate broker, you were able to really see, some of the massive impacts that investing in commercial real estate had, on people that actually owned those properties. So I'd like to talk to you a little bit more about, kind of market cycles and timing the market. Obviously on the broker side, you kind of have firsthand experience to maybe get a general sense as to where things are going, depending upon where we're at in the current economic cycle and also depending upon which asset class. But, how does really the non-savvy investor, the investor that's not, on the front lines, absorbing, new information, coming out of, the broker community, how does the non-savvy investor really position themselves well to take advantage of different stages in the economic cycle?
Yeah, that's a good question. I think where I'll start is don't try to time markets. Don't ever try to time any market, real estate, stock market, or otherwise. It doesn't work unless you have a crystal ball, which I definitely don't have. One of my mentors once told me something I never forgot, which is there are no such thing as good and bad markets. There are only bad prices. So if you know how to underwrite an asset and you know how to protect yourself from a debt structure standpoint and make smart decisions about what an exit cap rate should be and what are reasonable rent comps and sales comps in the market. If you know how to do that and you know how to do that conservatively, you can buy in any market. It just gets harder to buy when there's more transaction, when markets are hot. So if you look at the last couple of years, I think we've been very fortunate. You and I, Jeremy, both have been working with sponsors who are buying for below replacement cost off market from distressed sellers. And the reason that we're able to do that is because those buyers didn't have a crystal ball, but got aggressive when the market was hot with their purchasing underwriting. And now we're buying low the assets that they bought high a few years ago. And it's not because we knew 2023, 2024 was going to be the time to do that. It's because we looked around at the current market conditions today and said, hey, this looks like a great time to buy if I can achieve good prices.
Yeah, it makes total sense. And I know that, some of our more savvy investors, yours and mine included, understand that transaction volume in the commercial real estate space has largely fallen off a cliff within the past few years. Given kind of what now, are you tending to see that perhaps maybe that transaction volume is starting to pick up now, especially in the wake of the Federal Reserve Bank signaling, lower interest rates going forward?
Yeah, I definitely think so. And I think everybody's forecasting that too. There have been two interest rate cuts this year. We just had one last week. The date today is November 11th. So yeah, last week we just had an interest rate cut. And I think a couple more are expected next year. Obviously, we're also expecting a new president and a Republican House and Senate going into 2025. So I think the winds of change are blowing, but these things don't happen overnight. I don't think you could expect to just wake up tomorrow morning and be able to get interest rates in the threes again. I think that's going to be a slow burn, and the Fed is going to be constantly watching the data to know where to stop it. From a long-term perspective, putting my economist hat on for a minute, I don't expect rates to get anywhere near where they were in 2020, 2019. I do expect them to settle lower than they are today.
Yeah, that makes sense. I would love for you to explain, if you're okay with this, explain to our listening audience a little bit more about that direct correlation between interest rates and exit, or I should say acquisition or exit cap rates. Are you able to kind of explain, why there's a correlation there and why that's something that all investors should be aware of?
Yeah, so the thing that you really got to know is the cap rate formula, right? Which is which is cap rate equals NOI divided by price or value. If you really can understand that formula algebraically, then you can understand that the interest rate is a component of your cap rate, meaning in a market that makes sense, and we don't always have rational markets going on around us, but in a rational market, your interest rate should be lower than your exit cap rate because the buyer should be able to create a spread, create a margin where they profit. Otherwise, why would they buy a property? In reality, markets are much more irrational than that. There's a lot of emotion that goes into why people buy, sell, invest. And the banks also don't perfectly track the federal funds rate, right? So there's like complex finance going on here, but whether you're looking at the 30-year or the 10-year or the Fed funds rate, you're going to notice little differences. But I think the thing to know is that prices, because of the cap rate formula, prices are supposed to have an inverse relationship with cap rates. So if you can begin to understand that, then you can begin to understand what exit cap rates should be given today's interest rate market. Does that make sense?
Makes total sense, and I appreciate you breaking that down for our listeners. I'd love to learn a little bit more about your days at Snapchat, if you don't mind. My question is really, what were some of those most memorable, challenges or maybe lessons learned, being the global head of real estate at Snapchat? That sounds like a fun time, working for the organization, in the time period that you did.
Yeah, it was a lot of fun. Obviously, Snap when I got there or when I started working with them as a broker was a very well funded startup, and still very much a startup. I wasn't there for this, but my boss was actually the guy that got them their first QuickBooks account, like literally got them onto computer accounting software instead of like cutting checks with a paper checkbook. So I was like one layer behind that, right? And when I joined, they had, I want to say, three small locations in Los Angeles and Venice Beach, where the headquarters initially was. And we had just done a deal for multiple floors at 229 West 43rd, which is the former New York Times headquarters in Times Square in New York. And that's where things kind of started to get like, whoa, like it's outside of California. And not only this, but we need offices in, pick an NFL city: Seattle, Dallas, Austin, Portland, San Francisco, Atlanta, Georgia, Boston. And then, oh, by the way, there was an acquisition and it happened in Wilmington, North Carolina. So now we need an office for those employees that we acquired. And now go to Europe and get space there and learn what it's like to transact in Amsterdam and in London and in Paris. And I think one of the things that I learned that were really important to me was you meet all kinds of different people, especially buying across asset classes or leasing across asset classes, across locations like that. They all tend to know the central thing, which is, I said this earlier, that real estate is a great long-term way to build and protect your wealth. So if you already have wealth, whether that's a lot of wealth or a little wealth, there's big buildings, there's small buildings, but commercial real estate is just a wonderful institution to water it and grow it and watch that plant flourish. And, we met as a well-funded startup. We were like the belle of the ball, especially in Los Angeles. Everybody wanted a lease from Snapchat. We were very credit worthy. So I got to see a lot of opportunity, meet a lot of very interesting people. And again, what I'm trying to do now at Multivestors is take what they know and give it to people like myself who grew up middle class. My parents were a school teacher and a carpenter. We didn't sit around the dinner table and talk about invest in private equity. It just didn't come up. And I'm trying to spread that message, having been exposed to that really by pure luck.
Yeah, it makes total sense. And those days at Snapchat during that hyper growth phase sound incredibly intense. And I'm sure you learned a lot there, and appreciate your perspective on, your parents or high school or college teachers not specifically educating you on, the power of passive real estate investing or in private equities in general.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investors. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Kind of switching gears back to Multivestors Group, what's really the vision for you and your business partner, Ben? What's the vision that you guys have for the company, as maybe you enter in, year 4 of operations?
Yeah. So as we're going into year 4, we have kind of two main goals. One is to just continue our ability to raise more and more capital. And the way that you do that is by spreading the message, getting referrals. We're starting to invest in a lot of different marketing tools so that we have sort of different channels where we're able to spread the message and get it in front of the right type of people who, similar to us, want to use real estate as a tool. That's number one. And number two is to begin diversifying. I think to your earlier point, transactions are tightened up, but they're expected to loosen a little bit in 2025. As they loosen, competition for those transactions is going to heat up, which means you're going to get bidding wars. You might start seeing assets at the end of next year and into 2026 start getting purchased for above asking price again instead of below asking price or off market with no asking price at all. And as that happens, we're getting ready for the market cycle to rotate. And we want to be able to create different types of investment options for our investors. We have some investors who have been investing with us across 3 years and are, frankly, feeling a little bit overexposed to value add multifamily. And we want to meet them where they are and say, here's something else that's gonna not be influenced by the same economic conditions as multifamily. And then we're always going to have new investors looking to come in and get into multifamily as well. And we're looking for safer ways to do that given the new environment that we're kind of rotating into, if that makes sense.
Makes total sense. Let's talk specifically about that new investor, right? That investor that's never passively invested in real estate or really any other alternative asset class outside of Wall Street. What types of investing advice, might you give that person? Where would you maybe point them? What particular direction to further their education and learn more about the benefits?
Yeah, I've already sprinkled a couple nuggets, so I'll try not to go back to anything that I already said. But I think another early learning that a new investor gets exposed to, like in their first year, is you can make an underwriting say almost anything. You can create a pitch deck that has any number of returns, and it's easy enough to learn how to financially engineer the numbers. And I think one thing that you see happen is people kind of get way too in the weeds. It's not that you shouldn't do your own underwriting or that you shouldn't do your own diligence, but people are kind of getting distracted by the wrong things. And we talked a little bit, Jeremy, about cap rates. Like if you don't have a command of that NOI formula, you're asking the wrong questions. And I think it gets to a point where underwriting the operator and proving to yourself that they truly are a trustworthy operator with a good track record, who knows what they're doing, has invested across markets. You want to press on when the market wasn't as hot. How did you adapt? How did you communicate? Communication is a major, major key thing, rather than like going line by line into expenses. Not that expenses aren't important. They're an important component of solving for NOI, which is part of the cap rate formula. But I think it gets to a point after your first year where you realize the pitch deck can say whatever. What you really want to know is, did an honest person put this pitch deck together?
Yeah, no, I appreciate you mentioning that. And I've brought this up before, that there's a lot of people, Aaron, that I trust in my life, but there's not a lot of people that I trust or I would trust with $100,000 of my invested capital. That's for sure. So I appreciate you bringing that up. I also appreciate you kind of hinting, kind of towards this topic of leverage, right? There's ways in which we can leverage other people's time, other people's experiences, other people's network. And that's really what passive investing in real estate is doing. You're effectively leveraging somebody else's time, experience, network, knowledge, et cetera. So what would be maybe a few different ways that you're personally leveraging, your time, experience, and knowledge when it comes to vetting other sponsors? And what type of criteria do you typically use before you decide to partner with a new or an existing sponsor?
Yeah, that's a good question for me, because that's literally what my day job is right now. So one thing that we do at Multivestors is in the fourth quarter, which we're living in right now, we tend not to be raising capital. We like to use the end of the year to kind of organize our business, stay close with our investors, catch up just on a personal note. And one of my big goals as sort of the real estate driver of our business is to go and vet. I want to vet 50 different sponsors in the fourth quarter, and I want to do it across asset classes, which makes it even more complex. And the things that I'm looking for are, again, we talked about that track record. I don't want to be getting into a sponsor's first deal, which is kind of funny because everybody had to have their first deal at some point. We had our first deal once upon a time. But we don't want to be getting in with significant capital to an investor's first deal. We want to be diving into their waterfall. And there's a lot you can learn through the way that somebody puts together their waterfall. I think there's kind of this beautiful balance between a very simple one and a very complex one, where neither of those extremes are great. You want to find that beautiful middle ground where someone is savvy enough to create a slightly complex waterfall, but is also simplifying it enough so that the LP is not making ever less return than the GP, than the operator. At the end of the day, the limited partners should always be doing better than the operators. And the other thing that I'm looking for is, this is a small world. This is something we haven't talked about yet, is commercial real estate, or not even just commercial real estate in this country tends to be a small world. I heard your name 100 times before I ever met you, Jeremy. And there was a reason for that. It's because you're a person with a great reputation. So it's not hard to ask around about you and hear good things. And there are plenty of resources online, forums where people give their unbiased opinions about operators that they've been exposed to. And I think those are kind of the most important pieces of information that you can collect, because I can get that information in an hour of research. I don't have to pick up the phone and call 50 different operators. I can look around about them on the internet. I can access my network, ask lawyers, CPAs, other investors, who have they done business with in the past, where have you had good experiences, and I can really condense that list very quickly.
Yeah, that makes total sense. And Aaron, I thoroughly appreciate your plug on myself. So thank you for that. Brand equity is all people have at the end of the day, right? You're either adding to your brand equity one drop at a time, or you're losing it in bucketfuls. So I appreciate your perspective there. And for the listening audience that doesn't understand about waterfalls that Aaron referenced, it really pertains to those cash flows as they move throughout the deal, and ultimately as those cash flows, circulate to the key stakeholders, which obviously includes the senior lender on the bank, obviously includes, mezzanine, level investor or investors, if there are, preferred equity, common equity, all those types of things. So, and then you hit the nail on the head, as it relates to really, looking into and vetting other sponsors in the space. One of the things that I have a lot of confidence in, when I bring investment opportunities to potential investors, is the fact that I've personally deployed my own capital with the sponsor a few different times before I would ever choose to partner with them on leveraging other people's money and bringing them into those opportunities as well. So I really appreciate you breaking that down for us. What would be maybe kind of one big mistake that you see a lot of investors making, when they first get into investing in the private equity space? What's kind of maybe one of those common mistakes that you would encourage investors to avoid?
Yeah, I think the first one that comes to mind, Jeremy, is their money is burning a hole in their pocket, and they just feel like they have to deploy it. I don't really know where that feeling comes from. There's probably some interesting human psychology going on there, but you see people, especially when they're going to buy their first building, you're underwriting 20 properties a day, and you're up in the 2, 3, 400s before any of them make sense. And then you do that thing where you start loosening the standards of your underwriting because, maybe it's me, maybe I'm the problem. And the truth is that you're not. You have to be very diligent, and you really should be evaluating hundreds to thousands of opportunities before making your first ever investment. And that gets easier over time. But I think one of the most common mistakes that I come across is the first time somebody learns about real estate investing, the first time somebody realizes that there are avenues for it to be passive, they just want to deploy their capital into like the first shiny thing that they see. And unfortunately, there are a lot of shiny things out there that aren't so great. So you see people kind of skip out on doing their diligence, don't do the thing where they ask for referrals, don't ask the right questions along the way. And it's because they just want to get that investment in the door.
Yeah, I think that people generally have this sense or this fear of losing money. And what's interesting about that is if you've got cash deployed in a savings account, earning 4%, but then somebody says that they can earn you 20%, that fear of losing 16% ongoing is motivation enough for people to, make emotional investments versus investments that are, based more on logic and fact. Would you agree?
Yeah, I would agree. And, again, it gets back to the creating optionality and having something to compare against. You probably shouldn't compare your passive real estate investments to your savings account. Those are apples and oranges. You should be comparing passive real estate investments to other passive real estate investments.
Yeah, absolutely. Touche there. Aaron, this has been incredibly impactful. I so appreciate the time that you've spent with our audience today.
Yeah, thanks a lot, Jeremy, for having me. Look forward to doing more of these, man.
Yeah, absolutely. And maybe before we go, what would be one or two different ways that our listening audience can learn more about you and connect with you offline?
Yeah, the easiest way to connect with us is at our website, which is multivestorsgroup.com. It's multivestorsgroup.com. From there, you can learn more about us. You can learn about our investments and our mission and our philosophy. You can schedule a call with us one-on-one if you're ever interested in taking some of our time. We're definitely interested in spending some of our time with you. So multivestorsgroup.com is the best way to connect.
That's great. And for my listening audience, I've had the pleasure of knowing Ben and Aaron for a few weeks here. They're stand-up guys, so please do connect with them. We'll put the links in the episode for today's show. And again, appreciate you being with us here today. Again, Aaron.
Yeah, thanks, Jeremy, for the time. Had a blast.
Absolutely. And listening audience, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.